You know, when it comes to the idea of infinite banking, a lot of people have questions. What is it? How does it work? How does it tie into a whole life insurance policy? Whenever I speak to someone about the banking concept, whether they reach directly out or if I call them, what I'll often say is, hey, Mr. Prospect Joe, from your research thus far, do you have any questions? Can I get you any information, whether it be on the idea of the banking concept, cash value life insurance, anything at all? And the response that I typically receive is, Steve, I understand the basics of the banking concept. I get that. But what I don't understand is the whole life insurance policy. I'd like to understand that further because I've seen some examples in the past that were not attractive, where I've owned whole life insurance in the past and boy, it was just ugly. I had nothing in cash value. Like there's no way I'm doing that. I remember one guy said, if this concept has anything to do with whole life insurance, I'm not interested. Then we start talking about whole life insurance and I asked, when you had whole life insurance in the past, did you have it? Yeah. What was the cash value right off the bat in the first year? It was nothing. It took me 10 years to break even. He remembered it. Okay, so that was a traditional policy. And then we start to explain how to set a policy up properly. My point is, he understood the concept. He was interested in that, but he didn't get this. He didn't have awareness around whole life insurance and how to set it up like a lot of big banks, corporations, wealthy individuals do that are happy with the product because they see their money available, what they paid in on day one. So what we're going to go through in this video is an overview of the banking concept. And then in the next video, we're going to touch on 3 commonly asked questions that people have in respect to whole life insurance they want to practice infinite banking. So really what it does, or what it is it allows one to use a whole life insurance policy as a financing tool, in the sense that once a dollar passes through the cash value of a life insurance policy, regardless if I just let that dollar sit and grow and earn, call it 5% over time, or if I elect to loan against it, if I borrow against the policy, I will continue to earn that 5% appreciation rate on the entire cash value. Any money I still have in the policy in the amount I loaned out. Now the question that always comes up is, well, how does that work? How does the company do that? We're going to cover that in the next video. It has to do with them collateralizing the death benefit. But with that said, before we get into that, a great way to illustrate this is with real estate. Because many have owned real estate. Maybe you own a home, you've invested in it before, whatever it might be. Let's pretend that you own this piece of property that I drew, and you can tell I wasn't an art major in school. And the appreciation rate, we're going to pretend, is 5% every single year like clockwork. Regardless of what happens in the economy, the real estate market, whatever, the fair market value of this property appreciates at 5% every single year, which means in 1 year, you could sell it for $105,000 if you wanted to. Now, if you own that home free and clear, you'll continue to earn the 5% appreciation on your entire property value. Of course, that's correct. Now, if you elect to borrow against it, let's say you take a mortgage against it or a line of credit against the property. We've got a cost to borrow, interest, that goes where? Goes to the bank. Now, in respect to the 5% appreciation, what happens with that? Is it paid just on the remaining equity or still on your entire property value? It's still on the entire property value. Meaning if you sell your home and it's worth $100,000, it doesn't matter if you have a mortgage outstanding against it or not. If there is a mortgage outstanding, you're going to net less money because it has to be paid off first. But my point is, it's going to sell for the fair market value. You get that constant appreciation. So how this relates to a whole life insurance policy is, let's assume it's earning a 5% net growth rate. Typically, the average growth rate with a policy that's designed properly will fall somewhere between 3 to 5% with the top companies, all of the important stuff. If you have $100,000 in cash value and you elect to loan half of that, $50,000, what's going to happen? You've got a cost to borrow, interest, that doesn't go to a bank, but goes to the insurance company. So there is a cost to borrow. However, in respect to that 5% earning rate, that is going to be credited still on the full $100,000 as if you never touched it in the first place. So there's no lost opportunity cost. Meaning if the cash value is going to appreciate to $200,000, say it's 10 years from now, if you just let it sit and grow, you'll see it grow to $200,000. If you borrow that $50,000 out or $90,000 out, however much, and then you pay it back right before year 10, you'll see your cash value fully restored to the $200,000 it would have been as if we never touched it in the first place. Assuming the earning rate and everything remain consistent, there's more to it, but just an overview of infinite banking and why a whole life insurance policy is still used is really because of the constant compounding. There's no lost opportunity cost. Yes, there is a cost to borrow, which we always want to account for, but my money can continue to work. And the whole idea to sum it up with that point, is if I want to purchase a piece of real estate, for example, what do most people do? Do they purchase their property in cash or finance through a lender? Typically through a lender or a bank, and then they're at the bank's terms when paying that loan back. The idea of the concept involves you funding a cash value life insurance policy, building up that bucket of money, that bucket of wealth. Now all of a sudden, when it comes time to purchase a piece of property, invest in a business, whatever it might be, instead of going to a bank, I can now go directly to my whole life insurance policy, borrow against my cash value, call it my personal line of credit, purchase the real estate, invest in my business, whatever it might be. So that's a very high-level overview of how it works. What we're going to answer in the next video, we're going to have some fun with this one, is as follows. So objections or questions we often receive is, hey Steve, I get the idea of the banking concept, but I don't understand the cash value. Can I have more of my payment in cash value? I'm doing this to maximize the cash value. How do I get more in a policy? That's the number one thing we always get. That's my number one interest as well. How do I maximize that? What's the actual cost to borrow? Is my policy earning a greater rate than what it costs to loan from it? And then 3, flexibility. You know, with a whole life insurance policy, in the name is whole life insurance. Does that mean that I have to make payments for my whole life? The answer is no. We can easily design a policy where it's very flexible, where we fund perhaps for a very short period of time. Maybe I have a lump sum of money and I pay into a policy for 3, 4, or 5 years. Or maybe I've got a situation where I bounce payments up and down. I pay $10,000 in one year, then $50,000 the next, then $30,000, then zero, then bounce it back up. You can really use it as a flexible savings asset and not a boring bill. So I hope you enjoyed this video. Please hit the like button, subscribe for more, and reach out if you have any questions. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.